Hi, welcome to the Crypto Republic. Before we begin today, if you're serious about staying ahead in this once-in-a-lifetime financial shift, make sure you like this video, drop a comment, and subscribe to the Crypto Republic. Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest energy updates and digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic. Bringing you updates every day at 9 a.m., noon, and 7 p.m. Eastern Standard Time. And here at the Crypto Republic, we give you the bird's eye view, a satellite perspective to spot the big picture shifts while everyone else is stuck in the daily chaos. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Well, ladies and gentlemen, something unusual may be happening in the XRP market. Not a headline, not a viral announcement, and not the kind of event that usually dominates social media. In fact, most people completely missed it. While the crypto community was busy debating token burns, price predictions, and market cycles, a much quieter signal may have appeared beneath the surface. A signal that some analysts believe could eventually change how investors think about XRP's long-term value. But here's the strange part. Two respected voices in digital asset space recently shared opinions that sounded completely contradictory. One suggested that reducing supply wouldn't significantly change XRP's value. Another suggested that a repricing event for the asset could still be on the horizon. Both arguments seem to point in different directions, and yet both could be correct. Because the real driver of market repricing in financial history has rarely been supply alone. It's usually something much bigger: infrastructure, regulation, and the moment institutions decide the system is ready. So the real question becomes this: what if the signal people missed isn't about supply at all, but about the global financial system quietly preparing for a different kind of infrastructure? Today, we're going to explore that possibility, and by the end of this video, you'll understand why some analysts believe the most important developments around XRP are happening far away from the headlines. As always, thank you everyone who takes the time to like, subscribe, comment, and share. These couple things really do help out the channel and get this content to people that really need to understand more about XRP. I salute you for that. How markets really reprice. Before we talk about crypto, we need to zoom out, because financial history shows us something fascinating. Major market repricing events almost never happen because of a single headline. They happen when infrastructure changes. Let me give you an example. In the mid-1800s, financial markets operated in a completely different world. News traveled slowly. Sometimes it took days, even weeks, for market information to move between cities. Then the telegraph arrived. Suddenly, information moved instantly. That technological change didn't just speed up communication, it transformed how markets priced assets. Another example came more than a century later. In the 1990s, the internet began connecting financial institutions around the world. Electronic trading replaced many traditional trading floors. Transactions that once took hours could now happen in seconds. And once again, markets changed. But here's what's interesting. Those transformations didn't happen overnight. They happened gradually, quietly, while infrastructure was being built behind the scenes. And only later did the market fully recognize what had changed. Now, fast forward to today. We may be witnessing another infrastructure shift, this time involving blockchain technology, the supply debate. Now let's talk about the debate that recently caught the crypto community's attention. Some investors have suggested that destroying part of XRP's supply, specifically tokens held in escrow, could significantly increase its price. The idea is simple. If there are fewer tokens available, each remaining token might become more valuable. At first glance, that sounds logical, but financial markets rarely work that simply. And that's exactly what David Schwartz pointed out in a recent discussion. His argument was straightforward. Reducing supply alone doesn't necessarily create lasting value. Why? Because price is determined by both supply and demand. If supply shrinks, but demand remains the same, the long-term effect could be limited. And history supports that idea. Several crypto projects have attempted large supply reductions. In many cases, markets reacted briefly and then returned to previous levels. Once the excitement faded, so, if supply reduction isn't that key driver of long-term repricing, what is? The other side of this argument. Ladies and gentlemen, this is where the second perspective enters the conversation. Researchers from Grayscale Investments have suggested that a repricing event for XRP could still occur, but not for the reason many people assume. Instead, their thesis focuses on something much larger: regulation, and more specifically, regulatory clarity. One proposal receiving attention is the Digital Asset Market Clarity Act. The goal of the legislation is to define clearer rules for digital asset markets in the United States. Why would that matter, you're asking? Because institutional investors operate under strict regulatory frameworks. Many large financial institutions cannot hold certain assets until regulators define clear rules around them. So regulatory clarity can sometimes unlock capital that was previously unable to participate. In other words, demand could change dramatically, not because investors suddenly become more excited, but because they are finally allowed to participate. But here's where things get really interesting. Even if regulatory clarity improves, that alone doesn't create long-term value. There still has to be infrastructure that institutions can actually use. And that brings us to the XRP Ledger, baby. The XRP Ledger was originally designed with a specific goal: fast settlement of financial transactions, not hours, not days, but seconds. For years, many observers viewed this primarily as a payment technology. But the scope of blockchain infrastructure has been quietly expanding rapidly. And this next part surprised many analysts, because several technical developments are currently being explored around the XRP Ledger. Developments aimed directly at institutional use. So infrastructure building. First, privacy. One of the biggest concerns institutions have about public blockchains is transparency. This is vital. So important. It's massive. Every transaction is visible. That level of openness can create compliance challenge. So developers have been researching advanced crypto systems that allow transactions to remain verifiable while protecting sensitive information. Second, tokenized assets. Some exchanges are exploring ways to represent traditional financial instruments like stocks or bonds as blockchain tokens. For example, Kraken has discussed expanding tokenized asset infrastructure across multiple blockchain networks. If the systems like this mature, investors could theoretically trade digital representations of real-world assets around the clock. But here's the fascinating part. Those assets still need settlement infrastructure, which brings us back to XRP. The global FX market. Let's talk about scale for a moment. The global foreign exchange market processes more than $7 trillion every day. It's the largest financial market on Earth. And despite the technological advances of the last 2 decades, many cross-border payments still rely on systems built decades ago. Transfers can take days, fees can be significant, and intermediaries can often be required. So financial institutions have been searching for faster settlement solutions. Blockchain networks are one possible answer. If even a small fraction of global financial activity moved onto blockchain settlement layers, the infrastructure supporting those systems could become extremely important. And that brings us back to the idea of repricing. Not driven by hype, ladies and gentlemen, driven by token burns, but driven by infrastructure, adoption. I want you to think back to the early internet. In the mid-1990s, most people didn't fully understand how transformative the technology would become. Companies were experimenting. Protocols were being developed. Infrastructure was still being viewed as incomplete as far as I'm concerned. But behind the scenes, a new digital economy was forming, and eventually the market recognized it. Some analysts believe blockchain infrastructure may be moving through a similar phase today. Early experiments, slow adoption, quiet development, and the possibility of much larger applications in the future. But the real twist, this is where it gets spicy. The real twist in this story is that the signals many investors watch, price, charts, hype, cycles, token burns, might not actually reveal what's happening beneath the surface. Infrastructure developments rarely move in dramatic headlines. It's very boring, honestly. It's like watching paint dry on the wall. It moves slowly, quietly, piece by piece. Legal frameworks, technical upgrades, institutional partnerships, each one may seem small on its own, but together they can reshape entire markets. So here's the what-if scenario. So let's ask an interesting question. What happens if even a small percentage of global financial infrastructure begins migrating onto blockchain settlement networks, you might ask? Not necessarily tomorrow, not necessarily this year, but gradually over time. What if banks start using blockchain systems for cross-border payments? What if tokenized assets become common in global markets? What if digital settlement networks reduce transaction costs across the financial system? If even a fraction of those possibilities materialize, networks designed for financial settlement could become extremely valuable, and that possibility is exactly what some investors are watching. Let's bring everything together. There are 2 important ideas circulating in XRP discussions. The first says that reducing token supply won't automatically create long-term value. History supports this argument. The second suggests that structural changes, regulation, infrastructure, institutional adoption could eventually reshape demand. Both ideas can exist at the same time. because they're describing different forces, supply narratives, and infrastructure adoption. And if financial history has taught us anything, it's that infrastructure tends to win in the long run. So here's my final thought. So maybe the real question isn't whether XRP will experience a repricing event tomorrow. The real question might be much bigger. What happens when global financial infrastructure evolves? What happens when markets move faster, settle faster, and operate on new technological foundations? And if that transformation unfolds over the next decade, which networks might be positioned to support it? That's the question many investors are quietly asking, but I'd like to hear your thoughts. I love everyone's comments. Do you think blockchain settlement systems could eventually reshape global finance? Or do you think traditional infrastructure will remain dominant? Let me know in the comments, because the conversation around digital assets is still just beginning. Well, good afternoon, ladies and gentlemen. Exciting times in the markets. Sorry, today's video is coming later. I had a lot of phone calls today overseas. I never want to get caught in the what if forest. Today I want to talk about something. I want everyone to pay attention to what we're paying attention. This is really important as far as I'm concerned. And anyone that retains any capacity loves hearing our take and why we find this very, very important. But if you're still here, I'd like a like and a subscribe so you can follow along. And if you're new here, welcome. Half the video is a rant. So to see where we're going, you'd have to go to yesterday's video to see everything builds off of that. But I'm paying attention to this right now. Again, on Tuesday morning, Maritime Tracking Data, AIS, showed a strategic movement of the giant U.S. warship USS Tripoli. The ship was spotted approaching the Strait of Malacca off the coast of Singapore, heading towards the Middle East. Massive ground and air reinforcements. So if you look at, according to ship tracking data reviewed by CNN, the amphibious assault ship departed its home from Sasebo, which is a port frequently used in routes towards Singapore, Japan, on March 11th. The ship is carrying a strike force from the 31st Marine Expeditionary Unit, MEU. Here's what we know about the strategic importance and the history of an island that's very important, where they're going, okay? This is what we're paying attention to, right? There's a lot going on where this ship is en route to, okay? We're paying attention to this because, again, we've set the table. I told you what the special source is, what we're following, what markets, and why. Ladies and gentlemen, there's an island dubbed Iran's unsinkable aircraft carrier, located just 14 miles south of the port city of Bandar. Abbas Qasim dominates the Clarence Strait. I want you to write this down. The Clarence Strait is very important. It's also known as Quran, and it acts as the primary platform for Iran's asymmetric naval power. Okay, it's very, very important. While exact figures regarding the number of Iranian fast attack boats and coastal batteries hidden within the island's subterranean labyrinth remain heavily classified, their strategic intent is clear. So this is very, very important. Again, this houses their ability to close the strait. Again, they're described as a missile city underneath it, and why I'm going over this is this military base in the island has effectively controlled or closed the Strait of Hormuz. Okay, so this is how they've successfully done this. Through shipping traffic through the strait was effectively halted last week when Iran threatened to strike ships passing through this. Again, this is what we're paying attention to. So we don't know, there's going to be a landing there? Why are Marines on the way? Now, why I'm paying attention to this is very important in any capacity. There's a lot of things that people will pay attention to in markets. There's a lot of noises, right? But sometimes paying attention to the ones that are going to drive the geopolitical narrative is what's going to drive the trades right now. I want to welcome all the new members of our membership channel and all the new members of our Patreon. Remember, ladies and gentlemen, one good tip from the pit can easily pay for your entire year's subscription. So if you want to hear the deeper macro research and learn how we take advantage of all the things I'm going over, please do come and join the almost 400 members in our Patreon community. And welcome to all the new members joining. And I love talking with everybody because that's really where we go through all this and everything like this. But again, why I'm paying attention to this, and this is the most important thing right now, besides the other things going, the market's in a state of range bound. And when the market's in ranges, it's digesting news. People don't want to get caught one way or the other, especially if you're a bank trader. You definitely don't want to get caught one way or another. You definitely don't want to get caught up like sushi here. You definitely don't, right? And I'm going to get to going over gold, silver, XRP, everything like that. But you can see what's really happening right now again. So the market's in a state of a holding pattern. But what we're paying attention to is that straight. That straight right now is what, to me, is what's going to drive the price of oil, what's going to drive everything. So you have a double whammy this week, as far as I'm concerned. Again, what I also don't understand when I get into this, I love how the crypto world has haters. I don't understand this. None of this is financial advice in any capacity. It's just my own opinion. I've never seen the tribalism in any financial asset ever before in my financial career, nor the peoples that mentor me still, that I still talk to. You never saw companies really bashing another publicly traded company. Oh, you're this, you're that. I don't like you. You're terrible. You can't, you this, you that. You're mean to me. You're worthless, whatever. Who cares? It's about making money. Nobody cares. But then again, it's something new I got to understand. For people that don't like XRP, simply put, don't own XRP. For people that don't like ICP, simply put, don't own ICP. If you don't like HBAR, don't own HBAR. If you don't like Quant, don't own Quant. If you don't like these coins, don't own them. But what's the purpose of bashing them? Because if they go up, and when they do go up, what are you going to say then? It's something that I've yet to really take into consideration, but the markets are basically feeding off of this. So you see Bitcoin pressing high around 74,000, right? Trying to go high. You see XRP trying to go higher. Everything's higher right now because it's in a state of flux. Again, it's range bound, moving ranges, right? Again. And that is where you can really get cut up like sushi, really bad, really, really bad, because at the end of the day, it's going to break one way or another. You understand me? So listen carefully, because what we're seeing right now is one of the clearest examples of policy uncertainty at the highest level since the global financial crisis. As of today, markets have gone from pricing 60 basis points of rate cuts by end of 2026 to just 25 basis points, one cut. Repricing didn't happen gradually. It happened in a matter of weeks. And the reason? Oil, war, and inflation, uncertainty. So if you're still positioned for a clear Fed pivot, you're already behind. Operation Print It to Win, it's coming. Don't get me wrong. That's what we're preparing ourselves for. And everyone that retains any capacity, that's what we're preparing as well. Besides feasting off of the situations from the chorus of chaos that we're capitalizing off of. Because right now it's just too easy as far as I'm concerned for market professionals. It's like it's raining alpha. But again, I want to talk about the Fed's function reaction. Let's get into institutional about this. The Fed operates on a reaction function. Inflation, core PCE, labor market, employment, wage growth, financial considerations. Right now, every single one of those inputs is distorting. Core PCE baseline projections, 2.5% for 2026, but rising energy prices are a clear upside risk. Labor market, not strong enough to drive wage inflation yet, but not weak enough yet to justify aggressive cuts. And here's the key institutional insight. The Fed does not forecast under geopolitical uncertainty. It defers. That's why their message is we will monitor and respond. We will monitor and respond. English translation, they're flying blind. The same way what we just went over about the Straits and what we're paying attention to and why that island, that is what you're paying attention to right now that you're not hearing in the news. Write those things down. You'll thank me later in the comment section, okay? I want to talk about energy shock. Again, this is the primary macro variable right now. It's very important. Let's talk about what actually moved markets. Oil didn't just go up, ladies and gentlemen. It repriced the entire U.S. rate curve. Okay, so if you look at data points late February, 60 bips of easing priced, now 25 bips total easing priced. That's not just a shift. That's a collapse in the soft landing narrative. And here's the institutional comparison, 2022 versus 2026. In 2022, energy shock hit tight labor markets, okay? Real wages declined, real PCE consumption slowed, but the economy had sick momentum. It was doing good. Today, labor markets confidence is weaker. Workers are not pushing for wage increases. They want to keep their jobs. Consumption is more fragile. Same shock, weaker systems. That means the transmission mechanism is very different. This time, energy doesn't just cause inflation. It directly suppresses demand. This is so important. Super, super important. I want to talk about the stagflation matrix that we're paying attention to. The stagflation matrix. Institutionally, you can model this as a matrix. Scenario, inflation, growth, Fed, response, soft, landing, down, stable, cut inflation, shock, rising, stable height recession, lower, cut, aggressively stagflation, current, do nothing. We are here. We are here. If that didn't make sense, rewind it. But where we are, we're here. We're stagflation, do nothing. And this is why the Fed is stuck, because cutting into inflation destroys credibility, hiking into slowdown accelerates recession. Now, here's a key data point. The Fed's long-run neutral rate is still 3%. Even if they adjust slightly higher to 3.125, the long-term path still implies 50 bips of cuts through 2028. So the system is telling you, short-term uncertainty, long-term normalization. But markets don't price long-term. They price the next shock. So if you look at the bond market mechanics, this is where you sound and you see everything. If you look at this, this tells you everything. Again, let's talk like an institutional desk for a second here to everybody. The expected reaction if the Fed turns slightly hawkish, bear flattening of the yield curve. Again, rewind this. I'm taking the PhD, but I want you to get used to this language as we're going to use it more and more on the channel. Again, that means short ends yields are going up. Fewer rates cuts expected. Long end stable. Terminal rates unchanged. And we're already seeing early signs that the 10-year Treasury yields rising towards 4.5% range. But here's the nuisance most people miss. Term premium has not exploded yet. Data shows term premium remains relatively contained at 0.3% to 1%. That means the market's not pricing in fully uncertainty yet, which is crazy. But if Fed does shift higher, or even one member signals hikes, higher rate volatility, rising term premium can be triggered. Disorderly bond sell-off, lions and tigers and bears on mine, and that spills into everything. Equities, credit, tech, multiples. So if you look at AI, productivity, energy constraints, now let's connect this to the biggest narrative in markets. AI-driven productivity, institutional consensus says AI leads to higher GDP growth. Yet to be seen. AI leads to higher equilibrium rates. Yet to be seen. But here's the friction. AI is both capital intensive, energy intensive. So when energy prices rise, the rates rise. The cost of deploying all infrastructure increases materially. That creates a lag effect. Slower CapEx deployment, lower near-term productivity gains, which means the AI saves growth narrative gets delayed. And here's the second order impact. Lower productivity plus higher energy costs equal higher real rates pressure. That's structurally bearish for risk assets. Again, so if you look at the Fed internal dynamics, let's go deeper. Watch the dot plot and descents. This is what we watch, because that's where the real signal is. Again, so we look at the baseline expectations. A median still shows 2 cuts, 50 bips, but fewer members supporting cuts, possibly upward revisions in inflation. Reduced descendants from doves, that's a hawkish shift without policy change. And here's a key nuisance. Even removing one projected cut is a major signal, because it tells you the Fed is leaning towards inflation risk, no growth at all. Again, you're going to have to rewind that, taking the PhD out of PhD for you. So let's summarize this like a fund manager. Again, let's everyone see how you're a fund manager. Let me summarize all this for you, right? We have a geopolitical shock, energy, driving both inflation and growth downside, forcing the Fed into inaction. Markets are repricing a mild outcome, but the data shows highly unstable equilibrium. And historically, those don't resolve smoothly, unfortunately, ladies and gentlemen. None of this is financial advice. They resolve with volatility spikes, liquidity gaps, violent repricing. So if you're there thinking narratives, you're late. You're thinking in flows, data, and reaction functions, you're early. Again, ladies and gentlemen, if you want to understand how we dissect this and we turn this into money-making situations, do come and join us at the Crypto Desk Monthly and the Patreon. We're helping people take the PhD out of PhD. And one tips from the pit pays for your entire year. And it's helping people understand. Now, why I went through all of this, right? Because this is what investors are preparing for. And this is really important, right? Again, you take into consideration what we just went over about the straits, what I'm paying attention to, but I'm going to tie in XRP, why this is conditioning with this in just 1 second, so stay with me. I want you to realize in the metals market right now, there's a mindset that the market to sell it, right? It's out there. They're selling it. The market wants to sell. If you look at gold, you look at silver, it wants to sell, but it's moving sideways, okay? They're selling into weakness. Now, if the market continues to go sideways, they'll sell them. They'll do anything right now, but sell it if it goes higher, right? The longer the market goes sideways, I'm more encouraged, right? Because they're not going to sell rallies, CTAs. If it goes lower, anything but going higher, the CTAs are going to sell this in metal. So depending on where your positioning is and what you want to do, depending on what your portfolio is, none of this is financial advice, that's where you position yourselves in the futures market or your physical positions. Again, right? I'm under the situation that I want the clearest path of resistance, and I think the clearest path of resistance is up as far as we're concerned. Again, there's just too much happening right now, right? So the longer this stays in a sideways, if you look at what commodity trading advisors, they sell into this. And then when the news comes, they basically have a little laughter about why they're doing what they're doing, but they want a rally because it makes their life easier. That's really what they want, okay? They want the life, they want it to go higher because it's a lot more of exciting. Remember, I tell you this all the time. They need to make their monthly, quarterly, and weekly numbers, right? So if the market is just like, if it's lackadaisical or it looks exhausted, they sell that. If it's range bound from one point to the other, they sell that. They can take advantage of that, right? But really what they want is they want a nice rally. They want somewhere to go. And in this environment, it's easier for it to go higher than it is to go lower. That's just the way that it is, but it needs permission, as far as I'm concerned, to go higher. Silver's the same way, if you look at it like this, right? And I keep thinking that things will go lower before higher is because people will take advantage of range training and somehow take profit. That's where that's coming from, as far as I'm concerned. But is what I'm looking at it right now, and I'm looking at Fed Day coming, and there'll probably be a spike one way or another, but I'm looking more at what's happening with the straight. I'm looking at the MEU on the way there. Again, so I'm not really looking so much at, the fundamentals, the technicals. What I'm looking at is geopolitical narrative. That's what I'm looking at. I'm not even looking at what's happening overall with what the Fed's going to say or do, because that can be short-lived. I'm not worrying about what Scott Bassett's saying, working with the trade deals with China, what they're saying, maybe using gold as a settlement device or not. I'm not really looking at that. I'm looking more at what's going to happen when those ships get to their area of operation. Because to me, that's a break. That's a catalyst for a move one way or another. Yeah, we could have Fed Day and that could move everything one way or another. Don't get me wrong, but geopolitical events has gotten us to here. Geoeconomics is a theme. Geopolitical events is a catalyst. That catalyst, when that ship gets there, that's the next, as far as we're concerned, on or off ramp with this. Again, so, when you're looking at this, I think that right now, you always pay attention to what's quiet, what's not paying attention, what no one's paying attention to, right? So to me, what nobody's paying attention to, no one's paying attention to XRP, no one's paying attention to ICP, no one's paying attention to HBAR, because these are infrastructure plays. These are RWA infrastructure plays, not financial advice. So as far as we're concerned, this is where you rotate alpha that you have made in other markets and you buy a depressed asset. Again, that's how you maximize your portfolio. Again, right now with the chaos that's coming, and we believe when that ship gets there, there's going to be some form of event that's going to push the markets one way or another. That's why we're waiting for that, is anyone who retains any capacity, and why. We've already set the table here with all the plays that we're looking at and why in the last videos. There's a saying in prize fighting: everybody's got a plan to being profitable until they get blasted in the face. Most people got blasted in the face. Now, getting up is up to you. Do you want to get up or not? I can't tell you how many times the markets have blasted me in the face. But the most important thing, again, are those events that we're watching, because that will move everything. Everything. But we're taking advantage of all the LNG plays we told you about. We're taking advantage of what's happening with the nickel issue, the copper processing issue, because of the lack of sulfur coming out, being shipped. We're taking advantage of all of these because these are further downstream than the immediate reaction to what will be in the crude oil market or WTI, okay, or nat gas. Again, we're looking at this because if we take out that island, if the Marines land on that island and take over that island, you take away Iran's military ability to choke off that strait. And that could have a lot of implications for a momentary whipsaw on price action. Does that clean up the whole problem going forward? We don't know, like we said, because yesterday we said it could take one crazy lunatic on the side of the shoreline to do something crazy to affect that. But that to us is the main event coming. That to us is what we're watching. But in the interim, play the ranges, not financial advice. Look at the ranges. If you're day trading or you're weekly trading, the ranges are your friend. Don't FOMO this. You're not missing out on anything. You're not going to wake up tomorrow and things going to go. This is how people get cut up like sushi. No one wants to buy something when it's rock bottom cheap. I don't know. If you can get something cheap, hallelujah. That's like shopping with coupons. What's wrong with that? So someone won't buy something. Nobody liked XRP when it was below $1. People are like, it's garbage. It's this. It's worth ungats. Then when it started moving, it looked like it was going to do something. Everyone's like, oh my God, I got to get it. People got it at the top, but you're playing this for the long term. Nobody can tell you in good confidence if you're even going to wake up tomorrow, I'll be able here to make a video with you. So how does someone know what's going to happen tomorrow's price action? You have a better understanding to know what's going to affect and influence price action than where it's going to be. I mean, seriously. So as far as I'm concerned, understanding the world is changing, and you see everybody every day talking about it. But right now, the market's in ranges. It's digesting this. So if you think you're going to be late to the party, you're early. This is where you get that Gucci discipline. This is where you get that Gucci conviction. This is where we pack up. And as a financial mercenary, you're going into battle every day now. But once the lines are drawn and you can see where everything is in multiple markets, you feast on the people getting caught up like sushi. That's what you do. You follow strict money management. You follow your recce. You follow your trading plan. You follow everything. And if you want to learn how we do this, come and join us at the Crypto Desk Monthly. We'll show you. But stand strong. Remember why you got in this, and don't FOMO. Don't get caught up like sushi. See the main picture, the main reason. Because when Operation Printed to Win It begins, and believe me, it's going to begin, you're going to be so happy that you got involved for yourself, for your financial future, whatever you can in any capacity, not financial advice. Because that's why we do this every day, for a better life. A better life. And this is all about real assets. It's upsetting seeing the world's situation right now, but the one thing about upsetting situations, they create the greatest trading opportunities. I mean, if I could go back, what do you think about Halliburton? How many people made money off of that? I mean, my God, if you go back and you see what caused it, it's unbelievable. But ladies and gentlemen, the other thing I think is important, what MasterCard has agreed to acquire BVNK for up to USD 1.8 billion, including 300 million in contingent payments to expand their digital asset infrastructure. The acquisition is intended to enhance MasterCard's support of stablecoin, tokenized, and deposit payment solutions. The deal requires regulatory approval, but if they're buying this, what does it tell you? The world's changing. Goes back to why maybe in the comments people can enlighten me about why everybody hates each other's coin. It's simple. You like a coin, you take a position allocation for yourself. You hope it goes higher. You don't go on social media and slag somebody else off because they like this coin. It doesn't even make any sense. Those are the big things that we're paying attention to, ladies and gentlemen. That's the most important thing. And again, you stick to your plan. Stick to what makes sense to you and why you're doing this. Because again, that's the most important thing, not getting cut up like sushi. Again, really. It's just there. But as always, this content is for informational and entertainment purposes only and should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Remember, the game is changing, and those who understand it first will benefit the most. Make sure you're on the right side of it. You have two choices. You can be like the crowd, reacting after the move, rationalizing why they missed it, telling themselves to never let it happen again. Or you can be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally, because some elements in history are loud, but the ones that change everything are quiet, right into the moment they're not. And if this is one of those moments, do not blink, because the world is distracting you with noise while XRP continues to develop behind the scenes and building momentum in the broader digital asset landscape. Stay sharp, stay informed, accumulate knowledge. Your move now will be remembered. This is not the end of the story. This is just the beginning. This opened your eyes, smash that like button, ring the bell, and leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to Crypto Public. We break down the major global banking trends shaping digital assets today, giving you content, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, and stay in the Republic. I love you all.